Hey, good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby P. Kinzer.
And I'm Thomas Doty.
And yes, we are the FITT Show, helping our people get their finances in shape. How are you doing today, Thomas Doty?
Simply marvelous.
Oh, it's very important that you stay that way because attitude is everything. Don't let nobody tell you different. Appearance is just 80%. But dope, man, got a lot going on, man, in the world today, especially in the financial realm of things. Last week we talked about watch out for fees because they can drain your your wealth that you have saved. It can eat to it so much, but enjoy yourself, but watch for those fees. But this week, we're going to talk about should you consider dividends. So, for a lot of people, they may not understand, man, why are we talking about dividends? Or what? Some people, everybody have a basic concept of dividends, but you need to understand dividends because you could be missing out on another alternative way to grow your wealth. And we're going to have a discussion about that today. And remember, you all, please at all times, you put your comments in the comment box because it helps us with reaching more people. That's how the algorithms work. But still, we like to make this interactive, so we use the comment box for that. Should you have any questions? And look, there's no such thing as a dumb question. Remember that. So put it in there. I won't say it came from you if you want anonymous. But only way we learn, y'all, is by asking questions, okay? So please do that. And if you have a comment or you have a subject that we want to talk about, and maybe it's something, not on dividends today, but if it's something that we can address right away, we'll do that also because we try to make it interactive. We want to not just talk to you all. And on this virtual podcast, that's the way that we can interact. So please do that. And then another thing is just remember, we are not financial advisors. We do not have any fiduciary responsibilities, and we are not registered reps, but we are financial educators. Okay. So keep that in mind. Remember, everybody's situation is personal. We giving you information on a general basis. But most of this information you can use and learn from it. But if you need further information, as we always say, seek to a financial advisor or one of your friends who is very intuitive about finances. Now, just don't ask everybody. Please don't ask Uncle Leroy at the cookhouse because he will tell you the get rich scheme and it's going to be broke. But but please ask questions, y'all. We encourage that. So please do that. Click on the like button and the heart button. That's so important. And like I said, please put comments in there. And if you don't understand something, please put it in the box and we will address it. And we always open to new topics, especially topics that are of concern, importance to you. We just try to give you as much information we can. Each week we pull from publications like Kiplinger, Smart Assets,
Fidelity.
Fidelity, yes, Vanguard. So we pull all this information from different places and we vet it and we try to bring it to you. So make sure you share on Facebook with your friends. Please share. Share. And on YouTube is subscribing. So a different way to subscribe, and that way we can get more traction. We try and look, you all, we're not compensated for this. We're not in it for the money. We're in it because we want to close the wealth gap that they always talk about between blacks and everybody else. And if you follow us, this has been 2.5 years approximately, though, about.
Yep.
This is our 167th show. And a lot of things, they say how you can actually tell something the truth. You test the truth. We have said a lot of things on here. And if you go and check them out, a lot of them have been right. It's not that we some great gurus. It's just that we've learned, we got between being dope, we got over. How many years, though, did you work for as an accountant?
41.
I worked 30. So that's 71 years of experience. And if we don't know, we know somebody that does know it. So
and we've been successful in investing and
the main thing, though. I mean, we're not just do as I say, don't do as I do. We try to stick to that. And let me tell you something. Dote is a CPA and an MBA, and I have learned so much from him. I am a certified financial educator, and I've worked in financial information and the Division of Finance for the FDIC for over 30 years. So we know a little bit of something, but we even tell you we don't know it all. We be learning stuff ourselves, don't we, Dote?
Yeah, and we share our mistakes, so you won't make those same mistakes. That's the important thing about learning, because so many of us never learned these things growing up. And the point we're trying to make is it's never too late to learn, never too late to start investing. But it's not a simple concept. There are things you need to know, and all we try to do is bridge that gap between what you should know and what you don't know. And we get topics and we try to break it down in a way that you'll understand it. Sometimes we apply our own personal situation to it and just try to make it easier to digest. But you got to be financially literate if you want to build wealth. You have to.
And we're in this information age. The information highway is at top speed, you all. And so it's so important to get authentic information, information that is correct, because there's a lot of people that are just putting misinformation out there. We try to give it to you directly from where we get it, and we vet it, and it's so important that y'all understand that. So we just want to make that.
One more thing I want to say to him, we've said this before, but if you're looking for a get-rich-quick scheme, then that's not what we're about. We're about building wealth over the long haul, consistently, constantly saving money, making sound investments, understanding your risk level, and knowing where you want to be and what you want to do. And we'll try to help you accomplish those goals.
And it is a lot of foolishness out there, you all. I'm not saying stop that daggone foolishness. There's two ways that you could be fooled. One, believing what is not true, and two, not believing what is true. Make sure you understand the difference. So, Dote, now, last few weeks, Dote, your stock market information has been, kind of sad. I hope you have something good. And let's start with our main topic at the top of the show, the stock markets. Everybody's yours and my friend.
Yeah, I tell you what, the stock market has done fantastic today. As most people know, the Fed dropped the interest rate by 0.5%. Most people, it was like a 70% guess that it was going to only be dropped 1/4 point, but they dropped it 0.5 point just because things are looking a little slower. And my own personal opinion is that they're wishing they would have done it sooner, and that's why they went 0.5 point. But if you look at the first column shows the prior week close, second column is our current close, third column is that change. S&P is up 118 points or 2%. NASDAQ's up 534 points or 3%. That's the tech stocks, which usually react favorably to interest rate cuts because money is cheaper. Those are growth stocks. They can invest and grow. Tesla's up 14 points for the week. Apple's up 6. Even Pfizer's up 1. And we'll talk about Pfizer being up 1. Nvidia's down 1 point. A lot of profit taking going on there, and Google is up 7. And one thing I want to make clear, and I'm going to make it clear because it plays into our topic today. When we talk about this change, the third column, that's just the change in the stock price, okay? You have to keep in mind that's not your total return, okay? If you own, let's say you own Microsoft. Last week it was at 427. This week it's at 439, okay? But also in September, it paid a dividend. Now that's not included in that change. So the actual return of Microsoft is actually higher than that 2.8%. because you have to include the dividend. And we'll talk a little bit more about that in our topic, but I just want to make sure you understand when you look at that change, that's just the stock change. That's not the total return based on the stock change and the dividend return.
Just the price change.
That's just the price change. Exactly. And you can see Apple's up 6. Everybody had a good week because of the interest rate cut. And if you look versus a year-to-date change, it's some real sweet numbers. If you were invested in the stock market this year, you did pretty good. S&P is up 20%, NASDAQ's up 21%. And you can see how those stocks have done for the whole year. As a matter of fact, the only one that hasn't gone up is Tesla, and it's down slightly, and Pfizer is flat. But again, remember, Pfizer is flat, but it's also paying up to a 6% dividend. So the stock price didn't change, but I still made my 6% annual return on that stock. So let's keep that in mind as we talk about this, when we talk about the stock price change versus the dividend. And that's what our topic's going to be today.
And though, just want to remind people, we have a different chart here. The last 2 columns are taking the end of the year prices, stock of prices, and then the percentage change between the end of the year and to date, which is considered the year to date. So we're going to be showing this. Those last 2 columns are your year to date, your total return from December 2023 to today. And that's some interesting return, though. I mean, those are great returns, man.
Yeah, and it gets more meaningful as you get towards the end of the year, and you can see what it did for the whole year. And it's more a better indication that you ought to be invested in the stock market. So if you look at this little portfolio of stocks I hold, you can see that some have done okay, some have done way well. I've had a pretty good year stock return wise, and carried by NVIDIA. NVIDIA is up 136%. I mean, it's more than doubled. So it's up over 100% of its original value. And everything else has done real well except for Tesla, which doesn't really pay a dividend, and even Pfizer, which is flat, but I still made 5% or almost 6% on Tesla. And so I've had a good year so far. And it could change tomorrow. I mean, everything could tank tomorrow. I doubt if it will. I doubt if everything's going to tank, but I've done okay this year.
So dope. My portfolio is not as large as your portfolio when it comes to value, but I did very well myself too. And we don't show my stocks. This is no competition by no means, but I've had a semiconductor stock that is up, over 100%. My gold is over $2,600. Though remember when we were last year, it was around like $1,800. Now it's over $2,600. Silver was around like $21. It's now $31 an ounce. And
Bob, remember the gold I bought?
Yeah.
IRA. I put in 15. It's now worth 18.
Wow.
Okay, I'm up 20% since April 15th. That's a half a year.
In that little time.
I'm up $3,000.
Dope. The Ford stock, it's just been holding, right? But it pays like about a 6.5% dividend. But the GM stock, though, is up by about $15. So that's the beauty of diversification. That's the only reason why I'm stating this, you all. As you can see, Doe is well diverse, and I'm diverse. And the name of the game, nobody's so good that they can just pick exact stocks that they know. But the name of the game is to have, a few, and maybe the ones that weren't doing nothing. And we're all about the long play. It's holding, because you never know what happens, because nobody got no crystal ball. All these financial advisors try to act like all these fundamental and technical analysis charts, but nobody knows. You just try to do the best that you can, and the name of the game is diversify. So with that, I want to talk about the cryptocurrency. Though cryptocurrency is up like I don't know what. The Bitcoin is up by almost $5,000 per Bitcoin, up at 9%. That's a hell of a return. The market is up about $144 billion, up 7%. Tether is holding Ethereum, the smart contracts, is up 5%. Solana and Dogecoin is not doing nothing. You know, just like they say, you might as well call that a dog coin. And that's your boy of your car you have. Elon Musk was trying to push that, and Mark Cuban. But if you were holding that Bitcoin, you know, it came back. It's up to $63,004, up from $58,000 per Bitcoin. So, you know, like we say, once again, I know y'all getting tired of us saying this, but it's all about the long play. It's all about the long term, you know, holding and, you know, don't be jumping in and out because nobody can really guesstimate what the market's going to do. The best you can do is hold on and hope that, you know, these companies do well. Though I just want to make one public statement. Because people are asking, well, wow, what does it mean when they lower? Because that's just the benchmark, right? When the Fed lowers the interest rates, that's the benchmark for what they lend to each other. But it then filters down to other things like mortgages, interest rates go down, car loans go down, credit cards, a lot of things it affect you all that it works for the good. People jump into the market more and jump out of bonds that are having low interest returns and getting high returns because so this is the kind of things that lowering the Fed about lowering the rates, things that it affect.
Yeah, it makes borrowing cost less for everybody, for companies, for individuals, for car loans, mortgages, and that drives the economy. When it's low, when it's cheap to borrow money, you're more likely to invest. You're more likely to buy cars, homes, things like Home Depot stock should go up because people are buying and selling homes. And as soon as you buy and sell a home, you fix it up to sell it, and then you fix it up and paint it and do all this stuff when you buy it. So those kind of stocks are poised to do well as interest rates continue to go down. And it just makes borrowing costs cheaper for everybody.
Yeah, and I mean, and though the theory is if you're making money more available, and this is crazy, but this is how macro and microeconomics work. It's encouraging people to spend more money. You're like, wait a minute, isn't that what got people into debt? But no, if you're spending more money, you're helping what? Companies and their products, and you're helping their stocks go up. And that's why people go in and invest because people are spending and buying products more because they got money freed up, income freed up.
And one more point, if you think about right now, interest rates are about 5% on money market accounts and high yield savings accounts. But as those interest rates go down, people start looking to invest that money into stocks to get a higher return. So once the high yield savings account and the money markets accounts start going down, people look for alternatives to make a higher return. And that money usually pours into stocks, which again drives the market and causes stock prices to go up. So a lot of positive things can happen when interest rates go down.
And this is a good segue, though. Since you're talking about stocks, we need to talk about today dividends, another alternative to growing your wealth.
That's for sure. And the reason it's important is because dividends can be a valuable source of income for investors, or if you're thinking about retiring. And the IRS, not a lot of people know this, but it's a fact. The IRS allows qualified dividends to be taxed at the lower capital gains rate rather than the higher income tax rate. Okay? And what that means is if you make $1 in dividends, you pay based on the capital gains rate, which is lower, versus if you make $1 of interest and you pay ordinary income tax. And so, again, all things being equal, you'd rather have the dividend and pay taxes at the lower rate. Okay, so we're going to discuss tax requirements to recognize a dividend as a qualified dividend. We'll discuss the benefits, how dividends work, and how they differ from how qualified dividends differ from ordinary dividends.
Now, I get feedback from our shows from individuals out there, and we have all levels. We got young people, we got old people, we got people who in finance majors, we got people who know nothing about finances. But so some people may think these, what we're talking about today, may be a little bit over their head. No, please pay attention to y'all, because this is something that people miss. Because we always talk about compound interest, right? The seventh wonder of the world, Albert Einstein said. People who understand and earn it, people who don't pay it. It's one of the vast ways to build wealth. But what people miss, is compounding dividends. And we're going to talk more about this, y'all. But see, regular dividend increases lift the yield on an investor's original cost basis of the stock. Now, stick around long enough, like me and Dodo always talk about the long term, the modest yield you receive on your initial investment can hit double digits in one day. Now, companies with long histories of annual dividend growth also offer some peace of mind. After all, any company that manages to raise its dividend year after year through a recession, through a war, to market crashes, and more is demonstrating both its financial resilience and its commitment to returning cash to the shareholders. So let's get into
let's talk about what is a qualified dividend. Okay, so just in general, a dividend is a way for a company or a mutual fund to distribute payments to their investors. Okay, these usually come in the form of cash, and is usually paid on a quarterly basis. And they also can offer other assets. We talked about stock dividends, where like NVIDIA gave you 10 shares of stock for every stock that you own. So you ended up, if you had 10, you ended up with 100 shares. They can give property, they can give services, but those cases are few. Typically, it's given in cash. And these earnings came more into play with the 2003 tax cut from George Bush, the tax law he signed in effect. And the Jobs and Growth Tax Relief Reconciliation Act created these breaks for dividends, okay? And up until then, all dividends were taxed at the rate of their regular income bracket, okay? But with this new program, taxes on qualified dividends were lowered. They're taxed at the capital gains rate, which is lower than the ordinary income rates. And this encourages entities to pay their investors rather than to hold on to their cash. And so when we talk about the dividend yield of a stock, that's the dividend amount paid per share. It's expressed as a percentage of the company's share price. For example, if Microsoft pays a $10 per year dividend and the stock price is 100, its dividend would be 10%. Now, we'll talk a little bit more about this. They usually pay it in quarterly increments. They usually pay one per quarter. And so not all companies pay dividends to the owners of common share stock, okay? And that's what you have to have in order to get the dividends. Orders, if you own preferred shares, which we won't get into much of that because that's not very common. But if you own preferred shares, you typically are guaranteed a firm dividend amount. We're just talking about common stocks. And so stocks with the highest dividend yields can sometimes be kind of fool you. A stock could have a real high dividend, but that could be because of some other shortcomings that the company has. So we're going to talk about some of the stocks in the S&P 500 that has high dividends, but in some cases they could be paying a high dividend that doesn't ensure that they are financially sound. Okay. If you really wanted to go hunting for a good company that pays a high dividend, you'd want to look at their history to see that they've been paying dividends for a number of years and that they have increased their dividends over that same period. And so that's what you have to look at when you're looking for companies that pay a decent dividend.
And Doe, let me break it down in layman's terms. A dividend is usually paid by a company because they want you to stay in their stock. They want you to hold their stock. And so it's almost like an enticement for you to stay in and hold, don't sell the shares in their company. So it's like a little incentive they get for people to stay in. So just get that, straight, and they just sharing in their profits and giving it back to the people. But it's really just to track you to make sure that you stay and don't cash out and then take your money somewhere else.
Again, and don't confuse the fact that a company does not pay a dividend that they're a bad company. If you are a growth company, you're taking all of your money and investing it in the company's future. Right. If you're trying to grow. If you're an established company, you can still have money to invest in the company's future, but you also give some to the shareholders, as Bob says, to keep them happy and to entice other people to want the stock. So there's a trade-off between a company paying a dividend and a company trying to grow. And so that's why you really have to be careful of what that dividend payment means. And again, you look at the history and see what it's paid over the past. And that's usually going to be indicative of how they're going to pay in the future.
So how qualified dividends work? Like I said, they're dividends to reward the corporate or mutual fund investors, right? So, you have to become a shareholder of a qualifying domestically based company to earn these qualified dividends. Now, if you are an investor, you will receive a dividend from the company whose shares you own. However, these dividends are designed for long-term stockholders. For instance, for a dividend to become qualified, you must hold on to it for more than 60 days. That must take place over a 121-day period, beginning 60 days out from what they call the ex-dividend date. Dope's going to talk about that. This date is the cutoff point for you to purchase a stock and receive a dividend from it. In other words, they don't want you to buy a stock, get the dividend, and then turn around and sell it. Because remember, now you're taking away from money that they can grow the company, right? So they don't want you to do that. So in contrast, if you hold dividends from a mutual fund, you have slightly different rules. You must hold a security unhedged for at least a minimum of 120 days out of the 121 days. Now, why the process may sound confusing, most dividends are considered qualified from U.S. companies. Essentially, if you keep the stock for a few months, you'll probably earn the qualifying dividend rate.
Okay, now let's talk about the requirements to be a qualified dividend. There's some criteria that the companies have to meet in order to get that special tax break. The IRS says that a company must be New York Stock Exchange eligible. Okay, and that could be a foreign company. Mostly it's domestic companies, but it also could be a foreign company that trades on the New York Stock Exchange. Okay, the dividends must be ordinary dividends. They cannot be capital gains distribution or some other type of special distribution, and it cannot come from a tax exempt entity. The holding period, the dividend must meet the necessary holding period, and common stock and preferred stocks have different holding period. I think Bob will talk about that, or I just talked about that, okay? And certain investments do not pay you in qualified dividends. So you've heard us talk about real estate investment trusts or REITs, and they do not qualify. They don't usually distribute qualified dividends to their investors. They give dividends, they're just not qualified.
So I want to take a minute and answer a question from Garnett. And it says, what's in it for banks or mortgage companies? I keep getting notices to get the equity out of my home.
They want you to borrow. they want you to
They
borrow.
want you to pay
They want you to pay
interest.
interest. That's income to them. They want you to pay interest. And that's, yeah, if you can, theoretically, if you can take that money and invest it and make a higher return, you're probably better off. But very few situations are good for borrowing. And most people, I shouldn't say most people, some people take that money and do things that may not make sense with that money. They may buy non-appreciating assets, but that's all they want. They want you to borrow and pay them interest. That's the bottom line.
And it works a couple of different ways, right? If you take out a HELOC, right, equity loan, right, credit line, you're going to have to pay it back. So say, okay, I'm going to take cash out, right? And all they did now is just tack on that amount to what you owe. So, you still end up, they making up. And this is what people don't know. So, no, banks, I have a graph that I show to young people. The banks lend out 90% of your money, right? So now just think about that, right? They done loaned out your money, and then they're going to come back and say, hey, you want to take out an equity loan? We're going to charge you for that too. So they double dip. But let's talk about qualified tax benefit, dividend tax benefits. And qualified dividends are taxed differently than normal dividends. The former is taxed at capital gains rate. That means the normal dividends. So let's look at the 2024 brackets. For single and joint filers for qualified dividends. Let me bring that up for you. Let's look at that table so you can see the difference here. Stick with me here. All righty. Okay, this is what the qualified dividend, what it looks like, the table. And if you can see zero if you're single, and it's between $0 and $47,000. Filing jointly, it's 0 to 95,000. So you don't pay any taxes. But then you get into those tax brackets that are higher, like married and filing jointly. Then it goes from $94,000 to $583,000. That's a pretty big range, though. And you just charge 15% as opposed to being taxed your marginal rate, which could be like 24% or something.
It could be up to 37.
Yeah. So that's the whole story with that. And it is so what is the word I'm looking for? It's the difference. Definitely the difference. Now, capital gains are profits that occur when an investment is sold at a higher price than the original price. That's the price of the stock. But dividend income is paid out of the profits, like we say, of the corporation to the stockholders. Now, the tax rates differ for capital gains based on whether the asset was held for short or long term being sold. But the tax rate for dividend income differs based on whether the dividends are ordinary, and that's what we're talking about, or qualified, with only qualified dividends obtaining the lower capital gains tax rate, which is so great. But so for practical matter, most dividends in the U.S. qualify to be taxed as capital gains.
Let's make sure we're clear on that. So there's two forms of dividends. You got ordinary and qualified. So ordinary can also be called non-qualified, right? So their ordinary dividends are much more common than the qualified. And so just like qualified dividends, they are paid out from a company or corporation's earnings to its stockholders. And these payments tend to come from sources outside of stocks. And they could be savings accounts, CDs, REITs, those kinds of things. So reporting an ordinary dividend is a little different from a qualified dividend since it's not taxed in the same way. So any income from an ordinary dividend shows up in box 1A on that 1099 form you get at the end of the year, just like you would any other income. So it's taxed like the wages you earn. So if you receive more than $1,500 in these ordinary dividends, you got to fill out another form, and it goes on Schedule B on the 1040. It's interest in ordinary dividends. Whereas qualified dividends are taxed as long-term capital gains at the advantageous rate instead of regular income. So this taxation comes at lower rates. For example, Bob just showed the chart for the 2023 tax year. Those rates can go anywhere from 10 to 37%. And if you, like most people, you're probably in that 22 to I think 27, 28% tax rate on ordinary income. But the capital gains tax rate is capped at 20%. And in a lot of cases, for a lot of people, it's only 15%. So remember that your qualified dividends are also reported on the 1099 dividend form, but they're in box 1B.
So why are we telling you all of this? Like, what does this mean to you? Qualified dividends, new term. We're trying to get your arms around it. We understand that. If you're not a shareholder, then a qualified dividend doesn't mean much to you. But a lot of you are, especially if you got mutual funds too. There are dividends being repaid into the fund, and a lot of you all have reinvesting the dividends and don't realize it. But however, if you are considering opening a portfolio or becoming an investor, it may incentivize you. A qualified dividend comes with so many favorable benefits that appeal to both the stockholder and the company distributed. You can continue to reduce your taxes on your qualified distributions. For example, if you can offset your capital gains through tax loss harvesting, like if you had a loss of $2,000 in your stocks and you don't feel it coming back, you can actually use that against the capital gains that you receive on your dividends. Or you can put your investments in a tax-deferred investment like an IRA or your 401k. There's so many tax advantages that you can receive. Now, many people use dividends to support their retirement income. You know, like they say, they let it reinvest. They reinvest the dividends instead of taking the dividends as cash. They take the dividends as stock. Now, you do not have to pay taxes on income held in a retirement account, which will help you avoid taxes on your dividends entirely. So reinvesting, like I said before, may be a viable option. However, it's important to know how long a company may put your dividends, since it likely will not have a guaranteed term. And I want to make this statement. I know a lot of people who had stocks or did not state on and with their, say, financial institution to reinvest, and they get these cash and the IRS dividend payments. But if you reinvest it, and I got this question though, I have for you. If you reinvest the dividends, do you still have to pay the taxes on it?
You most definitely do.
Good.
Because the dividends are paid out to you, and you have to pay it, report it just as it's paid out to you. And a couple of things it does. It does create a situation where the bookkeeping gets a little more difficult. So you have to keep track. And typically the companies do that because you can choose, when you own a company, you can choose to receive the cash or reinvest the dividends in stock. And if they offer that option, they take care of the record keeping for you, because you have to be cognizant of that, because you have to determine your base or your I'm looking for the word, your cost basis when you sell the stock to determine your capital gain on that stock. So we strongly recommend reinvesting the dividends and buying more stock, because we believe in buying stock. That's just how Bob and I feel, but because we think it's going to pay off in the long run. And typically, if you get the cash, you'll just end up spending it. And it's always better to buy more stock. That's just a personal preference of Bob and I. Okay, Now let's talk about dividend-paying companies, and usually it's larger, established companies with predictable profits. They're the best dividend payers, and bear in mind, usually companies that are high growth companies don't usually pay very high dividend rates because, again, they're investing that money in order to fuel their growth. And so usually it's companies within the following industries that maintain a regular record of dividend payouts. And those are basic material companies, oil and gas companies, banks and financial institutions, healthcare companies, pharmaceutical companies, as Pfizer, utility companies. And there's a couple of reasons why, because usually there's not a lot of growth in those companies. So they kind of have to pay dividends in order to entice people to invest in their companies. But most of those companies have a steady stream of growth of income. And so they siphon some of that off to their shareholders. And as we said before, like REITs, they're required to make specific distributions to their shareholders. So they're required basically to pay dividends. Okay.
Well, when you say it's real estate investment trusts.
Yeah, REITs, yeah. And some firms will list their investment objectives, and they may issue regular dividend payments based on those investment objectives.
So, though we have these
list. Let's just show these are the highest paying dividend companies on the S&P 500, and you can see there's Walgreens, Atria, which is the cigarette company. Mm-hmm. I used to own that, and back in the day, I got a lot of money off Philip Morris, but then I got guilty about owning that stock, so I got rid of it. Franklin Resources, Verizon Communications, they're paying 6.3 dividend. Pfizer pays 5.7. Ford, which is Bob's, pays 5.6. There's Dow, a basic chemical company, and Kinder Morgan pays 8.5. And over to the right, you'll see the analyst consensus recommendation. So Walgreens, even though it's paying 11% dividend, the consensus is to hold that, which is it's not really negative, but it's saying don't run out and buy it. Atria Group, it says buy, because people who smoke are going to smoke. They ain't going to stop. They don't care what it costs. Franklin Resources is saying sell. Verizon, it's saying buy. Pfizer is a strong buy. And again, that's one of the benefits of owning a dividend paying stock. So like we said, Pfizer's at 30, but I still get that 5.7 dividend. So I get a higher dividend on that money than I could have gotten in the money market. Money market was paying about 5 up to 5.5. But I also have the possibility of growth. And that's the value of owning a dividend stock. So when you look at the total return, you have to include the dividend payment in addition to the stock growth. So basically, I have two possible sources of income. I have the fact that the stock might grow, and I also have the security of knowing I'm going to get that dividend every year. And Ford's a hold. That's one of Bob's. Dow's a hold. Kinder Morgan's a buy. And I can't read that last one. What is it, Bob?
Elf Peak Properties.
Okay, I'm not sure. That might be a REIT. I'm not sure. But those are just some of the highest paying dividends in the S&P. And some are good to invest in, the ones that the analyst consensus say buy, and some are not. And so some, like I said, they have to pay a dividend just to get people to invest in them.
Yeah. So that's pretty interesting. Dope. So who doesn't pay a dividend? Dope kind of mentioned this a little earlier. Young, fast-growing companies such as those in the technological and biotechnology sectors may not pay regular dividends since they may be in the early stages of development, so they retain their earnings to put back in the company for research and development and business expansion and operational activities. Now, investors tend to forgive the lack of dividend if company stock price is growing rapidly. So if they don't give a dividend, they forego that. But not surprisingly, once a company begins paying dividends, it finds it difficult to reduce or suspend the payments. This is seen as a sign of falling profits, not to mention a loss of income to shareholders.
Yeah. Now, let's make sure we understand those dates. It's just like if you're going to try to play football, you got to understand the rules. You have to understand the rules when it comes to buying dividends and making sure you get the money and you're able to take advantage of the favorable tax rates. Okay. So these are important dates. Usually a company is going to have an announcement date and they're going to say, okay, we're going to pay a certain dividend. Company management announces it, has to be approved by the board or the shareholders before it can be paid. Okay. Then you have what's called the ex-dividend date. And that's the date on which the dividend eligibility expires. It's called the ex-dividend date or simply the X dates. If a stock has a X date of Monday, May 5th, shareholders who buy the stock on or after that date will not qualify to receive the dividend. So you have to own the stock on the ex-dividend date. So if you own the stock one business day prior to the ex-dividend date on Friday, May 2nd, then obviously you would qualify for the dividend. Okay, then you have what's called the record date. And that's the cutoff date established by the company to determine which shareholders are eligible to receive that dividend or distribution. And finally, you have the payment date. And that's the date that the company gives you your money that they've told you they're going to give you in the way of the of the dividend. And that's when it's deposited into your account. So you have to own the stock on the ex-dividend date, and that it's announced, ex-dividend date, and then you get paid.
Yeah, that's a lot of information there, though. But that's how it works. So just to round this all up, and qualified dividends are way.
Now, before you close the loop, let me just mention one more thing. So if you buy the stock a day before the ex-dividend date and sell it a day after the ex-dividend date, you still get the dividend. But as Bob talked about earlier, it would not be a qualified dividend because it has to meet that other criteria of being held for 60 days within that 120-day period. So make sure you distinguish between those two things. The one is receiving the dividend if you own it on the ex-dividend date, but then to qualify for the qualified dividend treatment tax-wise, you have to hold that stock for 60 days in that 120-day period, which is 60 days before the ex-dividend date and 60 days after. You have to hold it 60 days and within the ex-dividend date, but you got to hold it for 60 days total. Make sure you understand that distinction.
So bringing this all home and to make it a little bit more understandable, qualified dividends are a way to reward or entice long-term shareholders. They are taxed at a lower rate than ordinary dividends, giving them a tax benefit status. You can increase your dividend income by putting it in a retirement income for when you're retired. If you want to incorporate qualified dividends into your income, consider speaking with a financial advisor. They can help you create a plan to adjust, your goals accordingly. Now, dividends are seen by many investors as a sign that a company is earning a healthy profit and, more to the point, is willing to share with its investors. Not all companies pay dividends, and not all investors care about them. If you do, look for the best dividend-paying stocks for your money. So with that, dope.
Hey, Bobby, one more thing I want to mention. This is another one of those things you should be cognizant of when you sell a stock. Again, it shouldn't drive your decision, but if the ex-dividend date is close by, at least look and make sure you aren't selling a stock right before the ex-dividend date. If you can hold it a few more days or a few more weeks and get that dividend, it may be worthwhile to do so. This is no different than making sure if you own a stock, you don't want to sell it a few days before it reaches long-term status versus short-term. So you have to mind your business. You have to pay attention to what you're doing. You wouldn't want to sell a stock right before the ex-dividend date and miss out on that dividend, just as you wouldn't want to sell a stock before it becomes long-term capital gain eligible. Again, those things should not drive your decision, but all things being equal, you should take advantage of those if you can.
So the lesson to it all, you all, just another alternative to expand your wealth is compounding dividends, receiving dividends, you all. So dope, let's go to the summary and takeaways. And that's a lot of information on dividends, but we're going to summarize it because we know we gave you 20 pounds of information in a 10-pound bag.
Okay, the big advantage to dividends, it gives you two ways for growth. Not only do you get the dividend, but you also get the possibility of growth. And so if you're more the conservative person, you pick a stock that's, you get that, not guaranteed because no dividends aren't guaranteed, but if you look at their track record and they've always paid a dividend, unless things go bad, they probably will continue in the future. So not only do you have that, but that company may grow. For example, Pfizer may come out with a new product and their stock price may take off. That's two ways to make money, which is what we're about, making money.
The other one is tax advantage. Qualified dividends are taxed at the capital gain rate, not the ordinary income rate. So that is definitely a major benefit. So consider the tax advantages.
Pay attention to your dates. Know when your dividend dates are. Know when to expect your money. You got to be cognizant of that, as I just mentioned a few minutes ago. So make sure you know what date you're supposed to get your dividends. And if you're thinking about selling, make sure you don't do it right before the ex-dividend date.
And lastly, what we're trying to bring this home as another way, consider dividends in your portfolio. You have other things. You have IT stocks. You have utility stocks. You can have real estate stocks or biotechs. But all of these can pay dividends. And like I said, when you reinvest the dividends, that's now compounding dividends. And it's such a way to also, as Doe said, another alternative way to build your wealth. And that's what we're here. We're just trying to give, we're not saying it's for everybody, but we only know what we know. So we're just trying to provide you with another alternative. So with that, I want to thank everybody for tuning in and want to wish a happy birthday to Garnett and Rodney. Both of them have birthdays.
Wow, happy birthday.
Happy birthday to you too. Happy birthday. You got to do the black birthday. It's your birthday, not for Play-Doh, but for real though. All right. Modestine, thank you for letting us know that. Hello, dear, down there in Lexington, South Carolina. Carl Chapman, my little brother. Always good to see you. Garnett, thank you for being here. And my sister Nolia and lovely Linda are on today. Evidently, Gloria is taking a nap because she's not on here today, but that's okay. My two sisters are representing for her. Yes, thank God. So thank everybody. Make sure that y'all tune in Next week will be 168th show. Wow, dope. We get down, we load them up, man. That's a great thing. And please remember to put in the comment box any topics you want us to speak about that is in particular of your interest. So, please do that. And dope, I like to leave with the quote of the day. Why you always be holding your breath, man, when I get ready?
Because I just, and as well as I know you, sometimes you surprise me.
Thank you. Thank you. Be careful when you follow the masses, because sometimes the M is silent. Have a wonderful day, you all.
Yeah.
You got it though, right, dope?
I have to think about that one.
One more time. Be careful when you follow the masses, because sometimes the M is silent. Have a Nolia's laughing. Nolia got see, Nolia's intuitive. Thank you all. Look, have a wonderful week, and we see you back here. Make sure y'all share and go out there and subscribe on YouTube. And don't forget to go out there and buy Bobby Kinser's book, The Other Side of the Hoop, the European Professional Basketball Experience. I just came out of Atlanta on the Wham Bam podcast. Going to be viewing next week on all the social medias. I mean, this guy has got over 100,000 followers, and I was on in Atlanta yesterday and did the podcast, and it was great. So check that out when you can, and go out on bobbykinzer.com. All right. Have a wonderful day. See you next week.